Yes, it's been an interesting 3 to 4 weeks. It's felt like 5 years, the last 4 weeks. On the macro side, obviously there's been some significant shifts in what I describe as self-inflicted pain by most Western governments on the coronavirus. It's pretty much unprecedented the way this is. The governments have decided to basically hit the handbrake on all economies as they try and manage the outbreak, which is of a virus, which you got your own views on that. But what that's done is obviously the leverage ratios in the economy have been steadily building since the GFC to being back to those levels. And if you look at some of the margin accounts are at record levels as well. So there's a fair amount of debt in the system again. And then when you have such a sudden demand shock, as it's always famously described, the tide goes out pretty quickly. And those with pretty poor balance sheets and or businesses where they don't have enough liquidity get found out pretty quickly. Obviously, the banks are the first to feel it. And while it's interesting this time is that given the changes in the legislation, and particularly things like the Volcker rule in North America, where banks really don't take much risk anymore, you've seen significant de-risking of the bank's balance sheets outside of just core fractional banking. And in particular this cycle, the banks have got rid of all their market-based businesses, like the funds management and the advice channel. So they literally are just collect deposits and lend it out. And given the level of capital now, they carry 2 to 3 times as much capital and more liquidity. You need a cataclysmic event for the banks to really fail here. And what typically happens in these markets is people actually, particularly with their deposits, go to the majors, in Australia in particular, because there's that sense of safety. So you have the banks, they took it in the next first of the cycle. But what I actually feel really tips the market right over, and it's a bit something no one's really talked about. It's known, but when the Saudis decided to crash the oil market, that really blew the market up. That destabilised the entire energy complex, and it made people even more nervous about what was going on. So you had the entire oil complex as well as all related industries taking the neck very quickly, with no ability to buffer that because it is basically the Russians and the Saudis have decided to not play ball. Again, this highlights, in the shale market in North America where there's a lot of high yield debt, they are very exposed. I suspect this is very tactical by the Saudis to try and blow that market up at some level, if they can. And I think it is sort of working. But the banks, this time, it's not a balance sheet problem for the banks. It is a profitability problem now. Because if you look at all the responses on the macro side, you've seen every government line up right behind the banking sector because they're very worried about that. Basically, if you look at North America or the UK and the European Union and Australia now, they're sort of guaranteeing lending at some level, so people with bad balance sheets don't have to sack swathes of people. Now with the job seeker payment, they're basically telling companies do not sack anyone for this period. Now, if we think down 12 to 18 months down the road, though, we're going to have to pay for this at some stage. I don't think growth will be strong enough to offset the level of largesse that's occurred. Most bailouts tend to punish the responsible and favour the stupid, is how it typically works, or the rent seeker, and that's exactly what's going on. If we look at one of the new ones in the US, new programs, which is hasn't been done before, there is quantitative easing going on, but what you've got the first time in the US a thing called credit easing. So the Congress has allowed or giving $400 billion in cash to the Federal Reserve, which they can gear up 10 to 1, so $4 trillion, and they will be basically lending directly to businesses in the US economy. Now, typically, the Fed has done monetary easing, so make rates low enough or liquidity high enough so that you can get through these sort of things. But this is the first time the Fed will typically be easing credit directly to the economy, not via the banks as a transmission mechanism. And that brings about all other issues because typically the Fed now has to pick who the winners and losers are. And with bailouts, you only attract losers. You don't typically attract winners. So what you're going to do is you're going to attract some very marginal business models that shouldn't be surviving at all, and you get a proper clean out. They'll be on life support. Now, the issue here is eventually those bad credits will become bad credit. So what we have now is you have a suspension of banks are going to have to take it on the chin regarding wearing accruing of interest, because people will not be paying their interest payments or principal payments. Your landlords are now have to face up to the fact that they may not be able to collect rent. They've basically got a stopping of the entire system, and this will bring up a few issues that we're not thinking about today, but that's what we're thinking about for next year, is that how does this readjust? Australia used to be a beacon of monetary stability, and now we're part of the rest of them with, embarking on our first QE program. And our biggest issue is that do Australian banks, now I'm not going to say they are, but do Australian banks start having some sort of zombie type elements on their balance sheet, which is the part that we're worried about. Because if any company that wasn't going to survive this, we generally believe that things will be different after this finishes, that demand level will be slightly different, the way people behave will be slightly different, particularly the way they shop, and that this will have an impact on those marginal business models, that they will never probably come out of this. And so therefore they're sitting on bank balance sheets, and do they come out and do they write these debts off at some point? So the one thing we have to think about is under AA, this is quite boring, AASB 9, this is an accounting standard not left by APRA or the RBA, is the expected credit losses. This is a new sort of standard. The banks are going to have to now start providing of the expectation of loss, not before the loss has actually occurred. So you could see in the first half a rather large bad debt charge be raised by the banks, and then given the payout ratios, and I just noticed overnight, all UK banks have announced that they are going to forego the dividends for the next 12 months, the next 6 months, and they'll look at the final for the next year. I suspect that'll be a persistent theme through the next 6 months, is that I think a lot of companies will probably walk away from not paying the dividend this half, or the final div, and holding it back for a later date. So holding onto the cash. So what we've been doing is looking at companies where they've got a little less exposure to this, and so we'll be able to actually keep paying the cash dividend out at the appropriate time, because obviously for the PIC, we're trying to make sure that we're collecting a dividend check so that we can keep paying them out. So that's the biggest side of it. When you look at the market performance, obviously the banks, oil, and which was quite surprising, is these real estate investment trusts performed really poorly in this cycle. So we would have expected that REITs would have done a lot better. We don't have any REIT exposure, but they are now, the REITs now look very interesting if you're willing to look past the next 6 to 12 months. So in the PIC, I'll just run through what we've done. I've got a few things I can't talk about because we haven't disclosed yet as a public company, but we've added 3 new names to the portfolio, which I haven't disclosed, and I probably won't be able to do it now. And they are high quality businesses which have been thrown out with the rest of the bad businesses. So we've initiated 3 new positions there at what I could describe as like 10 to 15 year lows. And all these operators have good balance sheets, plenty of liquidity, management we consider to be best in class. They are domestic stocks. One thing I want to particularly highlight is the board last week moved very quickly on the PIC, and they increased our global exposure to 35%. That was a discussion between myself and the board about the opportunities we're seeing and where we'd like to put more of our capital and just give us a bit more flexibility in times like this to take advantage of. There are good businesses in Australia trading at cheap multiples, but there are also really great businesses offshore which have been thrown out for similar reasons and are typically trading on lower multiples than the Australian businesses. So having said that, we have added a new position into the global fund, which again I can't disclose right now, but you'll probably see it in the next monthly report, where it's a business which has a similar compatriot in Australia, but it's as well run, and it's a high returning business, but it was trading at one point down to 13, 14 times earnings if you look through the cycle. So that's what we're doing right now, is looking through the cycle and going for mid-cycle margins, mid-cycle returns, and seeing what is trading at reasonably large discounts.